Okay, good. I do that. Okay, so if we go back, I thought it started, but anyway, don't worry. So in the case, okay, so in the case study here, what I was saying is that, okay, so we were discussing about, question 2 and 3, so you will think about that. And then the idea is to look really at the value creation associated with this investment. And in order to do that, just think about that. So I was doing that. Is you have the firm value, you have the capex, and you have the NPV. Okay, and so this is the value of the investment. Okay, so when you integrate an acquisition or a new investment, so you have the level of investment and the value creation. Okay, and of course, all that will be the value of the company after. So how can you assess? So the question 4 is about finding that. Okay, and the firm is financed by equity and is financed by leverage, long-term debt and short-term debt. And I'm going to say prime, and I'm going to explain why prime. Okay, so initially the company was like that. It was VE, okay, long-term debt and short-term debt, right? And then after investment, it becomes like that. Okay, and so it should be, I'm sorry, let's be very clear on that. Okay, it should be, of course, like that. Okay, and this is VI. Okay, so it's a balance sheet in market value, and asset side and liability side should be equal. So the idea is to measure V prime, that is to say the value of the firm after the investment. So the value of the firm after the investment, what is that? Well, the value of the investment is this. It's like the value of the debt plus the value of the short-term debt. But the value of the firm is also the value of the firm before plus the investment plus the NPV of the investment. But the value of the firm is also the sum of the free cash flow discounted at K prime. And so, you have all that to compute the firm value. Okay, so I'm going to help you a little bit so that you can work out through the computation and think about that. The way I want you to, in fact, it's not possible to go like that. It's not possible to go like that because we don't know what the stock price is. Okay, we don't know what the stock price is. So it's difficult to measure firm value, whereas we don't know what the stock price is. Okay, so the way we can do is we could do that. That is to say, we could do, so we have 1, we have 2, we have 3. So we could do 2. 2 would be possible. Okay, in fact, 2 is what we do in question 5. So question 5 will be using 2. And here, what we will be using is 3. That is to say, let's say that the firm value would be the free cash flow discounted to the cost of capital after. And the free cash flow is extremely easy because here the free cash flow is equal to the EBITDA. There is no taxes, there is no amortization, there is no capex afterward. So you don't have change in working cap. So you don't have all that makes it that EBITDA is not the free cash flow. Okay, so it's very easy. Figures are really very easy. So there's no difficulty into that. So here, the value of the firm is going to be the 1/240 over K prime. But the idea would be to find K prime. Okay, and K prime is the cost of capital after. And there, given the fact that you are in a world without taxation, what you can say is that the K prime is equal to K before. Okay, why? Because doing this investment, the investment has the same risk. So here, the level of risk that you have for the investment is the same as for the initial asset of the firm. So independently of the way you finance, too bad. Okay, so sorry. I think we don't need much now. Anyhow, just push that, stupid. So I was just saying that we are using that. Okay, it's recorded, so you have it. Okay, so we are doing that, and what we do here is we look for that. Okay, and this would be 1 to 40 divided by k prime. So, and this is equal to k because same risk. Okay, and whatever the level of leverage, what we're using is Modigliani-Miller without taxes. Okay, the best expectation I can have of the cost of capital is the cost of capital would be equal to the cost of capital today. Right? I'm going to try to see if I can open the other computer. Okay. It doesn't work. Okay, I'm here. Sorry. And so, so the whole case, I mean, not the whole case, but looking at the firm value after is to look at this, but this is equal to the cost of capital. So the story would be to think about the cost of capital before. And when you think about the cost of capital before, remember all this is in the end out. Either you do the WACC, okay, either you use something that the firm value is equal to the sum of free cash flow discounted to the cost of capital. That is to say, you can find the cost of capital of the firm by the WACC using the liability side, or you can compute the cost of capital using the asset side and saying that, you know, firm value would be equal to the discounted cash flow discounted at K. Okay, and in fact, you cannot do that. You cannot do that because for a certain number of reasons, but in particular, you don't have the cost of the short-term debt. Okay, so cost of short-term debt is unknown here. Okay, so what you can do, okay, is use that. And again, it's easy because as the free cash flow is stable, okay, as the free cash flow is stable, it's easy to find K. And I will leave you here to think about the case. And try now to look and understand. And there's not only the computation, there's the logic. There is the, you know, in this case study, what's difficult is that, not difficult, but what's difficult here is that this will tell you we should not invest. And when you do that, you will say, yes, we have to invest. And when you do that, you say, yes, we have to invest. In fact, this investment is good. Okay, and the idea is at some point we have to reconcile, understand why when we were using some reasoning, we would tend to say we would not invest, and then, you know, being really looking really at correct value creation with correct analysis, then you would like to invest. I think I can reload here. Okay. I think it works. Okay, so please, you know, the course is really about you, you know, learning, learning, and in order to learn, you have to do by yourself. When I do, it's easy. When you do, it's more difficult. Okay, so please, I'm back. See if it works nicer so that you can have me. Hopefully it works. Okay, so the idea is that you really have to think well about this case study. And honestly, this case study, you know, when the CFO of Fnac Darty, former treasury manager of Carrefour, is saying, you know, everybody working in finance should be able to do that, it should be a requisite, is because this is really sound reasoning to apply in corporate finance and be able to do that. because, it's called the Modigliani case study, and it was just a small remark, but, you can apply that to a huge real case study, and it's going to be the same problem, okay? Except that it's going to be more complex because the data will be complicated. That's all. Huh? So everything you have to apply is just about to think about it. Okay, now before we turn to option, we have two last things that I want to discuss with you. Capital asset pricing model and Modigliani-Miller propositions goes together, and then discuss a little bit of dividend policy, and then we'll turn to option pricing. That's going to be the new thing I want to do because we have to move on. So capital asset pricing model, easy. I think you know the relation. You tend to know the relation. I'm not sure that they are very correctly in place. Very often there are some mistakes. So let's discuss that a little bit. Plus, I also provide the proof, so where it comes from. So in fact, as capital asset pricing model and Modigliani-Miller have the same hypothesis, okay, you can have them together. And when you have them together, I just go where we want to go. I want to go here, right? But you will see that those propositions need some, you have to be in the correct hypothesis to do it. So the story is easy. Imagine that you have a leverage firm, you have an unleveraged firm, and you have a leverage firm. Okay, leverage firm and unleveraged firm do not have to have the same size. It's not a problem. And of course, we call beta the operating beta, but is also the beta of the equity of this firm. I call beta the beta, and the beta operating because the two companies are in the same risk class. Okay, so we have two companies that have the same operating risk class, but so you have the same operating risk, okay, but you don't have the same capital structure. And the first case we look at is the case of risk-free debt. That is to say, the debt here is risk-free. Okay, and I call here star the expected return here. That will be the cost of equity of the unleveraged firm, and I call ER the expected return of the leveraged company. Okay, and so how can we find that? How can we find this relation? So I just show it to you here because it's not that complicated. Okay, the way we can do that, I will try to do the maths quickly so that in fact, you use three propositions. The first is the capital asset pricing model. The second is the capital asset pricing model for the leverage firm. And the third is just the proposition 2 of Modigliani-Miller, saying that KE, the cost of equity, is equal to the cost of capital plus K minus R D over E. Okay, now as you are in a case with no taxation, what we know is K is equal to K star, the cost of capital of the unleveraged firm. So okay, this is the unleveraged firm, this is the leverage firm. The cost of capital of both companies is the same, and the cost of capital of the unleveraged firm is equal to the expected return of the shareholders of the firm, because there is no leverage. So cost of capital of the unleveraged firm is equal to the expected return of the shareholders of this firm. So it means that here you see that I can change here that, and what I can write here is ER star plus ER star minus R D over E. Okay, so I have, in fact, I'm going to try to do that on this slide. So I have three propositions. And from these three propositions, it's easy to have this. So let's see how we can work this out. In fact, you use look at that. So we use the second proposition. And from the second proposition, I can extract the fact that this here is equal to the ER star minus R over beta star. Okay, so it's just some maths. Okay, I just extract this. And then what I extract here, I replace. Okay, so I replace this in equation 1. Okay, so I'm going to replace that in equation 1, meaning that equation 1 will be ER R plus, so I replace this here, and I replace by what I have here, ER star minus R beta star multiplied by beta. Okay, so I have my first proposition is written like that. Okay, and now what I do, and that's not more complicated than that. Okay, what you do is I'm gonna write it. What you do, in fact, is just to say, I'm gonna write it on top here again. Otherwise, it's difficult to see what I just say. Is 1 is equal to 3. And so 1, okay, 1 is ER, and 3 is ER. But I say 1 is equal to 3. So I write down that R plus ER star minus R over beta star, the one I have here, okay, multiplied by beta, sorry, not using this one, okay. So here is my 1 is equal to 3, and the 3 that I am interested in is this one, is equal to ER star. It's just some small maths, but you know, it's good that you know a little bit about where it comes from. Okay, so you have this. Okay, and then it's basic maths. Okay, so here you have R, so you can remove that and have R here. And then you can see that, you know, it simplifies. Okay, it simplifies because you have ER star minus R, ER star minus R, ER star minus R. And what's left, if you look what's left is beta over beta star. So if I write it here, beta over beta star is equal to 1 plus D over E. And this is it. Okay, so what I wrote is KPM. So I wrote the KPM for 1, the KPM for 2. I wrote the leverage. I use Modigliani-Miller, the K, and K star is equal. So K, so here is really K equal K star equal ER star. Okay, and then I equate 1 and 3. And from that, I can see that I have this proposition. All right. So now all the second on that. So this is, so we have the relation that you all know, and you know this relation. We have a relation between the beta, the one we saw with pharma case study that we found, again, is we show how the beta of the leverage firm and unleveraged firm of firm in the same industry do relate. Okay, and then beta star is called the asset beta or unleveraged beta, okay, or deleveraged beta, or many ways to say that. Okay, what's important for you to get, I see many investment bankers saying Modigliani-Miller is theory. So they say, oh yeah, but this is theory, does not work in the real world, capital markets are not perfect, and blah, 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 blah. And then all the time, they use this kind of thing. Why I spend some time here to show you that I am using, in order to find this proposition, I have this is Modigliani-Miller. What I say is two companies with different leverage will have the same cost of capital if they have the same operating risk, independently of the capital structure, in a world with no taxes. We'll see the taxes all the second, okay? And you'll know how to apply correctly taxes in this kind of reasoning. Okay, so what I'm saying here is this is not, if you have to be consistent. If you use that it means that you are applying Modigliani-Miller. Okay, so do not say Modigliani-Miller is theory and then use beta, leverage, and deleverage. All right, so this is something that you really have to have in mind. Okay, second, if we want to move on, so here is proposition 3, and what I do here is I introduce, okay, I introduce proposition 1, 2, cannot remember. So I use the 2, so I use the beta, the KPM, okay, and then I use the KPM here, okay, and then it simplifies here, so that you finally have 3 components. So in the cost of equity, you are able to disentangle the risk-free rate, the operating risk premium, and the financial risk premium, okay? And of course, this would be the cost of capital of the firm, okay? And this would be the additional, okay? So it can also be that KE equal K plus K minus KD, D over E. Okay, here would be RF, because we are in the case of risk-free debt. Okay, so this kind of proposition is important because tell you how the cost of equity will be affected. Okay, beta star is always something very important. Okay, because you know this is what, okay, this is very important because it leads to K star. And it's really something that is associated with one industry. Remember that in one industry, homogeneous, we have the same systematic risk on the operating asset. And so having beta star is having K star. And it's always very important to be able to assess fundamentally what's the level of operating risk. So what it means is, you know, you may, if you want to invest in another industry, you are in a company, you want to invest in another industry, you may want to go on the market, collect some data on the beta of the stocks of the company, and then deleverage in order to have the beta star. And beta star will tell you what would be the systematic risk on the assets you are going on. So if the debt is risky, in fact, this would be far easier. And so if the debt is risky, okay, how do I find that? I can write it here down so that it's not obscure. So we can write that, okay, K, the cost of capital, the WACC is equal to the cost of capital equal to KE, E over V plus KD, D over V. But, okay, but, so now what you have here is, you introduce, so this is the WACC. WACC is equal to the cost of capital equal to, and now what you do here is you introduce the KPM. So for each of those, you will say R plus market risk premium multiplied by beta star equal, so this would be the K, okay, and then KE would be R plus, I'm going to try to do small, beta E over V plus KD. So I should say here, in case of a risky debt, I'm going to be a little bit more specific with beta D different than 0. Okay? I mean, it can apply if beta D is equal to 0, but this will also apply in case of a risk-free debt or a risky debt, but beta D equals 0. Okay? So remember, I can have a risky debt. Just want to tell you something here. Make sure that it's well understood. Okay, this is a risky debt because I have some default here. But if this is not correlated to the market, if the return of the debt and the market, the correlation is 0, then beta D equals 0. So I have a risky debt, but beta D equals 0. If I have the case of a risk-free debt, but we will show that. This is correct for a risk-free debt. This is correct for beta D equals 0. Okay, and where is, I haven't said that, where is the assumption of the risk-free debt? It's here. It's in the fact that, I took as the cost of debt the risk-free debt. But because if you have a risky debt, if the debt is risky, remember, for a debt is exactly the same thing. KD equal R plus market risk premium multiplied by beta D. So if beta D is 0, the KD is equal to R. So, and where do I have the assumption of R? Here. Okay? So if the debt is risk-free or the beta D is 0, if you have a risk-free debt, generally what you, or if the risk of the debt is not correlated to the market. Difficult, if you say, well, if the economy is bad, I may default, this is correlated to the market. Because if the economy is bad, it will affect the market. Okay, so say beta D is 0 and there is a risky debt means, for instance, okay, I may, if I lose a big customer, okay, then I will default on my debt. My turnover will be too low and I cannot repay my debt and I will default on my debt. Okay, so my debt becomes risky because I lose a customer. So this would be specific risk. And as this is specific risk, I can say that beta D equals 0. But generally, we do tend to think about risky debt because of systematic risk. But anyway. Okay, so to go back here on that, so you write down that the cost of capital is R plus market risk premium beta star, operating beta, KE. Okay, you write down that the KE, you write the beta of the stock, and for KD, you write down R plus market risk premium beta D, D over V. Okay, so what you just write down is the KPM for all the different expected return. And what you have here is you can simplify R, because RE plus RD, E plus D equal V divided by V1. So I can eliminate that. And then you can eliminate market risk premium, market risk premium, market risk premium. And so using the wet definition and applying the KPM for each of the asset or of each of the claim, operating, equity, leverage, you have this proposition. Okay, and what we have in this case, is the operating beta. Okay, choosing a capital structure will, when you choose a capital structure, I will summarize that in a minute. If you choose a certain capital structure, you split the operating risk between a risk for the shareholders and a risk for the debt holders. Okay? And maybe one thing on that, you can check something. Beta star equal beta E over V plus beta D, D over V. Okay, so operating beta, beta of the equity, beta of the debt. Okay, and you can check that if beta D equals 0, okay, then you have beta star equal beta E over V, because this would be 0. And so you can write that beta is beta star V over E, but this is beta star E plus D over E, and this would be beta star 1 plus D over E. And this is exactly what we had before. That is to say, this is the general proposition, and the beta D equals 0 will tell you exactly what we found before. That is to say, the same relation between the beta and the beta star. Okay, so that's what you have in mind. But applying this proposition, if the debt is risky and the risk of the debt is correlated to the market, is wrong. Okay? Okay, so remember, this is consistent. So this is completely consistent to the case study, the small case study we saw before, that if you leverage and the debt becomes risky, then you split the operating risk between the shareholders and the debt holders who now bear a part of the operating risk. Okay, so now decomposition of the cost of equity in the case of a risky debt. Okay, so again, I write proposition 3, and here again, I use the KPM, and I use the KPM. Now I have a beta D because beta D is different than 0. Okay, and so what I have is this proposition now after simplification, and what we can observe, if you compare this proposition with the one that we had before when the beta is equal to, if the beta is equal to 0, you had beta star D over E, in the case beta D equals 0, and so what you have is that the financial risk premium is increasing, but is increasing less quickly than when the debt is risk-free. So this is exactly what we said before. So you increase the level KE, okay, and when the debt becomes risky, and and if beta D is equal to 0, if beta D, if the default risk is correlated to the market, then what you have is the financial risk premium will increase less. Okay, so KE, the financial risk premium, okay, the growth of the financial risk premium will slow with the level of leverage. Okay, and so this is extremely counterintuitive, as I said yesterday, to say that, when the debt is risk-free, you have a linear increase in the cost of equity, and when the debt becomes risky, then the risk of shareholders is increasing less, which is something that's correct. That's the way it is, just because you split here the debt holders and you split the risk with the debt holders. Okay, so I'm not going back on that, but okay. So I don't think this is very difficult what we said before, just useful for case studies, etc., and real life to have those propositions clear in mind. Let's discuss in 15 minutes quickly about dividend policy. What Modigliani Miller, so we saw that Modigliani Miller 1958 tell you that, when you increase leverage, KE increase, but the risk increase. And finally, there's no increase in value. Okay. And what Modigliani Miller are doing in 1961 is to discuss for the first time dividend policy. If I'm telling you that, is because we still hear so many stupid things about dividends, so many stupid things, that it's good to have the reasoning of Modigliani Miller of 1961. Well, and so what they show again here, they show that, well, you can increase dividend, but what you give away under the form of dividend is lost at the level of the stock, and so you cannot create value. Okay, so irrelevance proposition, meaning that there is no increase in value. So if you increase the level of dividend, it cannot increase the value of the firm, and it cannot increase the stock price. Okay, and I think this proposition is extremely important. You have many people outside the finance world that would say, well, if you pay out more dividends, so you will enrich your shareholders. No, because what's given away to shareholders that they have in their pocket is lost at the level of the firm. Okay, maybe before we enter into that, I want to tell you a couple of things of generalities that I want to tell you about level of dividend. A couple of things that are like that that I have in mind that may be important for you. First, dividend is increasing. If you look the level of payout in Europe, in the US, the level of payout in 2000 was around 25%, and now the average level of payout is certainly more than 60%. Okay, and not only you have dividend, but you have buybacks. Okay, share buybacks. Buybacks in the US it's around maybe one half. That is to say, when you pay one of dividend, it depends on firm, of course, but one half of dividend overall in the US. In Europe, it's lower. The share buyback in Europe, be it in France, Great Britain, elsewhere, is lower. But to be clear, payout keep on increasing over time. And this payout that increase is really a puzzle still. So the idea is this increase in payout something that is bad for firms? What are the reasons for that? What do we know whether this payout has real effects that are positive or not positive? And it's difficult to say for sure, but I'm going to share a couple of thoughts on that. I think one of the main reasons for this increase of dividend is shareholder governance. Okay? Not that if I receive a dividend, I will increase my wealth, but it's a way to discipline managers. Okay, so the idea is that if you require firms to pay higher dividend, you tend to push managers to be able to deliver the dividend. So I think that the surge in shareholder governance since 30, 40 years, but 20 years in France, in Europe, okay, it's such that there's behind this push in dividends and share buyback some managerial discipline. So there is some agency theory behind that. Another reason for this growth is that profits have been increasing. Okay, that profits have been increasing a lot. And profits have been increasing, especially if you look in the US, but also in Europe. We know that on average, there were mergers of firms, and profits have been increasing. I would say for the trademarks are more important. So you have like premium firms, okay, and those firms are able to sell product at high prices. Okay, and the other reason. So, you do marketing, you are able, and people are able to pay a monthly wage in a telephone and in a phone, and of course, you make a lot of money out of that. So the idea is that all this can explain the increase in profit, and this increase in profit can lead to, of course, you have too much money. So what do you do with the money? You return it to shareholders. Which makes sense because you have more money than what you need to invest. The other reason is more related to competition. Okay, and there is new thoughts about that the competition, especially in the US, there are a couple of studies that tends to say that the level of competition of firms between themselves is going down. And so it means that profit will increase. So this would be bad in a certain sense for the consumer and for the economy. Okay, and this, of course, higher profit again would lead to higher payment to shareholders. Okay, and the reason competition may decline is because of large institutional investors. Okay, so when you have like BlackRock and sorry, so if you have like BlackRock, never know where there is a Seer or Vanguard, etc. Why? Because those institutional investors, they are in all the companies. BlackRock is at the capital of all the listed companies. So if I own 2%, 3%, 5% of many companies in Europe, I can organize less competition. So there are new research being done on the fact that having big institutional investors and Vanguard and etc., those people may push for some collusion. Okay, so again, this would be bad news. Okay, so those big investors, they may discipline managers because they are powerful and allow shareholders to have diversified portfolios, so you have the best of every world. But at the same time, if they reduce the competition, it's going to be bad for customers and for competition and innovation, etc. So there are some research being done on that would say that. Okay, so dividends have been increasing. I think this is something that is important. The second thing, and honestly, I am looking at the case of France, and I need to inquire more. There has been some work being done in the US along those lines, and it's interesting to see what will come out from that. Second, what I want to tell you is about how do we measure dividend. And in fact, dividend, there are three big measures. First, you use some payout, like you take dividend per share over earning per share, you take a total dividend over free cash flow to equity, so you tend to have a dividend to a level of something that you can pay out, okay, etc. The second way to measure payout is to measure dividend over the stock price. So here you will measure some dividend yield. And the last thing you can do is measure the dividend per share growth. Okay, so the idea is here you are looking at dollars. Okay, so I have 1 and then 1.1 and 1.2, etc. So what I'm interested in is some monetary increase in the dividend. So this is the way we can assess the dividend policy. Of course, when things are going nicely, that is to say, imagine that a firm has earnings that are like that. So these are my earnings. And then it's difficult to have everything here, but let's say like that. Of course, then, the stock price would be like that. Okay, so this would be the stock price, CT, and this is the time. So earning, the stock price would be here. And so, if I give up, for instance, 30% of my earnings, so this would be the dividend I pay. Okay, then it's easy to see that, this is the market cap of the firm, same. It's easy to see that if you do dividend by earnings, the payout will be stable. Okay, and if you do dividend over market cap, the dividend yield will be stable as well. So when things are smooth, when earnings are increasing and you pay out the same level of dividend, and of course the dividend per share will be smooth as well. So everything will be smooth. Dividend yield will be fixed, payout will be fixed, and dividend per share growth will be stable as well. So everything is stabilized and nice. Okay. The problem is when things are becoming complicated. That is to say, like if there is you have a crisis here, you have a shock, and earnings are going down, and the market value is going down, and then you may maintain your level of dividend. So you see, it's easy to see then that maybe the yield will increase. So if you take dividend by capital market, it will increase, and maybe the dividend yield, the payout will increase a little bit, but maybe not the same, etc. So what I'm saying is that when there is a crisis, and you can change, modify your dividend or not, but the market cap is going down and earnings are going down, you see that it's difficult to have something smooth. Okay, so this is a couple of things I wanted to tell you about dividend. There is a very, very heated debate in the US on share buyback, dividend. Just to tell you, in US, okay, in US, dividend plus buyback over the last decade in 2019, okay, on the SP 500. So in 2019, just before the crisis, buyback plus dividend was like 93% of earnings. So that's a lot. So meaning that, you know, for me also, when you look at those figures, you say, well, there's something that when you pay 93% of your profit under dividend and buyback, there is a problem or there is something. So it really means that, you know, this push on dividend and buyback may have negative effect on employment, may have negative effect on investment, may have negative effect on innovation, except if it is because firms are making so much money. And why they may make so much money? Because they are very good to have an image, but you cannot imagine that all the companies are in this situation. Or maybe there's a problem of competition declining, or only because, you know, managers are becoming stupid. That is to say, instead of investing, they want to please, or they want to fake that they are working well, providing dividend. Like, you know, if you pay dividend and buyback, you give to the shareholders the feeling that you work well, but you may not work that well. Because at the end of the day, what's creating value is R&D, is CapEx, is innovation that will lead to positive NPV projects that create value. And if you give away money, what's given away is lost at the level of the value of the firm. And so that everything is very complex. And if you look at the Larry Fink, so Larry Fink, who is the CEO of BlackRock, he is sending a letter to shareholder, to CEO of US firm every year saying, we don't want dividend, we don't want buyback, we want you to discover new project, we want you to reveal that you are able to innovate, we want you to show us how you address the problem of climate change, how you invest in sustainable investment. So, you know, the big institutional investors, they pretend that they push companies to higher investment and don't want buyback and dividend. Okay, at the same time, we still observe this increase in dividend and buyback. So is that really correct? Is it that managers are stupid and they just give away the money because they think they will be okay and have no problem if they do that? It's very difficult to disentangle. Certainly, there is a little bit of all that. Okay, so that's a couple of things that are important to say about dividend before going back to the reasoning. So this reasoning, if I do it, is just not to bother you, it's just that it's nice. So contrarily to capital structure, it's like 3 pages. Paper is really not that long, so it's very easy, but I think the reasoning, the line of reasoning is really interesting. So Miller and Modigliani are the first to provide the foundation for the analysis of the impact of dividend policy on firm value in, of course, correctly functioning capital market. And I think the difficult thing with dividend is to ask the question correctly. And I'm going to take here a scale, a time scale here. So this is the time, just to well understand that. So imagine here that the first date here, okay, I have a stock price of 340 and the dividend per share is 0. So you have a non-dividend paying stock, okay? And here you announce, okay, you announce that you will pay a dividend of 5. Okay, so here you have a change in, oh, sorry, I just have to take my phone. Just takes 1 second. Excuse me, 1 second, it's just because I have. It's an emergency, I agree. Oui, allô? Oui, oui. Mais il y a ma femme qui est là. Ah bah elle est là, elle est là. Bon bah. Bon, elle est où? Elle est. Vous la voyez? Bon, faites. Ouais, vous avez. Bon bah d'accord. Ok, merci beaucoup. Je suis pas là. Hein? Merci. Et donc vous avez la pièce. Merci. Au revoir. Au revoir. Au revoir. Sorry. So it's not that it's cold, but I have some problem in my house outside Paris. Anyway, so you have a stock price of 350 and dividend per share is equal to 0. And so, sorry, we go again. So stock price 350, no dividend. And then here you announce. So this is the announcement date. Okay, so you announce. And then there is the moment that you will attribute the dividend. What do you say here? What you say here is Mr. X receives $5. Okay, so at some point you have to say, well, today, okay, today we consider that the shareholders of the company are Mr. X, Y, etc. So this is the one that will receive the dividend. Okay, so I should state that better. Will receive $5. Will receive dividend. Okay, so you say who will receive the dividend. You fix who are the shareholders of the firm because stocks have been traded all day. So every day shareholders are changing. So at some point you have to say one day who are the shareholders that will be paid. And then what you have is the payout debt. Payout debt is just you send $5 to X. So you pay the dividend to the person. Okay. What you have to understand is what happens at the, okay, what will happen at the moment of attribution date. At the moment of attribution date, the stock price, oh, this one I cannot. Okay, so at attribution date, the stock price will decrease. No, I don't like that. I'm gonna redo it. Let me see. I don't have enough space here. Let me just erase that. And so that you understand. Okay. Let's see what's here. All right. So here you have this timeline. So my stock price is 350, 340, and my stock price is 340, and dividend per share is 0, and then I announce dividend per share. So here announcement, dividend per share 5, and here attribute. So imagine that when I announce, okay, the stock price, okay, so my stock price is C0, and here my stock price becomes 3, let's say 343. Okay, so when I announce that I will pay a dividend, the stock price is increasing by 3. Let's assume that. when I attribute here, so here I will consider that my stock price, of course, my stock price may change, but may change for other reason. What I am interested in is just the effect of dividend on the stock price. So the day just before, okay, it's 343, and the day after, which is the ex dividend stock price. So the stock price, so here is going to be C. So C prime 0 is this, and C prime 0 x dividend, so after dividend, is going to be 338. That's normal. The stock price, the date of attribution will decline by the level of dividend. Okay? And what is happening at the what is happening when you at the payment date? Okay? So when you have your payout here, nothing will happen. Okay, nothing will happen because after between all this period, that's the next dividend stock. This is a stock that the shareholder will not receive the dividend of the year. All right. So what do we mean by the question, does a firm's dividend policy affect firm value? What we mean by this question is to look at this. So what we are interested in here is this. What we are interested in is what can we expect from a change in dividend policy on the stock price. Okay, we know what happens at attribution date. We know what happens at the payout date. Okay, so the creating value with dividend means that if I announce a change in the dividend policy, it may affect my stock price. The very interesting thing about Miller and Modigliani answering the question is they are doing accounting. And what they're doing is to look at the cash flow identity. And what they say is at every moment in time, the sources of funds should be equal to the uses of funds. And what are the sources of funds? The free cash flow, increase of equity, increase of debt. This is the dividend. This is the interest expense. This is the debt reimbursement. So here is debt reimbursement, and this is the capex. Okay, what you don't have here is taxation. We still are in a world that there's no there could be some taxation in the free cash flow, but we are still in a world without taxation for the moment. Okay, so basically they say at any moment you have that. And then what they write is to say, well, it is impossible to change dividend payment and hold everything else constant. That is to say, imagine that I am this company, and imagine that I have 1 billion shares. Okay, so if I have 1 billion shares, and suddenly I decide to pay out 5 of dividend per share, it means that I have to find $5 billion. So it means that something has to change here. I have some equilibrium between my sources and uses of funds. And if I have 5 billion or 5 million or whatever you want on top of what I have today to pay, it means I have to equilibrate that. Of course, generally, if you have a firm and the firm increase dividend, okay? So if a firm is paying 100 million dividend more, the reason generally you increase dividend is because the free cash flow increase. So as the free cash flow increase, you increase the dividend. Okay, so let's think about that. I increase the dividend, but I increase the dividend because the free cash flow is better than what I expect. I did better than what we expected. So we do better 100 million, and this 100 million I pay out in dividend because I don't need the money. Okay. What's the impact of dividend on the stock price? Well, the impact of the association would certainly be that the stock price may increase. But why is the stock price increasing? The stock price is increasing not because of dividend. The stock price is increasing because if you have an unexpected increase in the free cash flow, then the value of the firm increases. And if the value of the firm increases, the market value of equity is increasing, and then the stock price is increasing. So you see that when you try to think about whether dividend affect or not the value of the stock, you have in a certain way to isolate the effect. Okay? If you say, I pay more dividend because I'm doing better, of course, if you're doing better than what was expected, the value is increasing. It's not the dividend that increased the value of the equity. It's not the dividend increasing the value of equity. It's just the free cash flow, the fact that the firm value is increasing. Okay, so what we say here and what we say after is the following. If you keep the cash flow, if you keep the leverage, if you keep the investment, I could say something else. I could say, oh, I pay 5 billion of dividend, or I pay 100 million of dividend because I reduce my investment. Okay? Is that good news or is that bad news? Maybe bad news. Because if you are positive NPV investment and you renounce to investment to pay dividend, then it means that the firm value will decrease, and then paying dividend will lower the stock price. But again, it's not exactly the interesting part of it. What we are interested in is per se, if I pay more dividend, does it affect the stock price? Not doing more investment or doing less investment has an effect on the stock price. So what we say here is, if you hold the free cash flow, the debt, and the investment policy of a firm, okay, an increase in the dividend. So what does it mean so if I hold the free cash flow, if I hold the level of leverage, this is leverage. If I hold the capex, the sole way to increase a dividend is to raise new money. And that's a very smart way to think about dividend. What it says is just the following, if I just summarize that. You have a certain level of, you have a firm has equity and debt, okay? And the firm has some free cash flow here, maybe the firm has some cash, etc. Of course, and imagine that you are not paying dividend. So for the moment, dividend is equal to 0. And suddenly you say, oh, I'm going to pay $100 million of dividend. Of course, if you pay the dividend, it has to come from somewhere. Okay, so it has to come from the cash that you have here, or it has to come from the free cash flow that will be at some point with the cash. Okay, so it has to come from here. But if you want to maintain your assets as they are, also with the certain level of cash, you want to maintain your asset and you want to maintain the level of cash. You want to maintain the level of debt, so you don't touch that, you don't touch your operating asset, you don't invest more, you don't invest less, you maintain the cash, you maintain the debt. Okay, but you decide to extract some money. Okay, you pay now some money out of dividend. You see that the sole way to equilibrate that is that you have to have new money flowing in the firm. So you have to raise some money on the market. So that's a very nice way to understand that dividend policy is just that you give on one hand some dividend, and on the other hand, you have to go on the market. So you organize some money circulation. Okay, like, you have the money circulating on the capital market. So you pay dividend and then you go back on the market. If you don't do that, you have less cash, so it's not the same firm, or maybe you can increase leverage, but then you don't have the same capital structure, or you may renounce to investment, but then it's not the same firm. And we are not interested in that. We want a firm that is the same firm, and then you have to organize that. So that's the nice thing about it. And so if you give dividend on one hand and you raise share on the other hand, what you could say is exactly what you saw. I remember when Microsoft paid dividend in the first place, there were those kind of reasoning. The first thing that you may say is well, okay, we understand that if we pay dividend, we have to replace with new money. But if I pay a dividend, okay, it means that maybe, exactly like we said before, stock price is 340. Stock price is 340. If I pay dividend, stock price become 343. That's what I think. Of course, if the stock price increase when you pay dividend, then it's going to be good for shareholders because the dilution that you will have, okay, when you raise equity, the number of stock was n and the number of new stock is small n. So what will happen is that you will have dilution for the new shareholders. But if you raise stock at the price of 343 and you pay out dividend to the former shareholders, then it's going to be interesting. But the problem is that that's not a reasoning. That's a tautology. It's a circular reasoning. You believe that dividend is good, push up prices. So, of course, it becomes interesting to pay dividend because if you pay dividend, then you will dilute your shareholders, but they receive more than the dilution that they will have. The second thing, so this is not acceptable as an argument. That's just a belief. The second thing is that we could say that if you pay a dividend, you signal that the firm has less profitable investment opportunities than previously expected, and you have a decrease in the stock price. What you can also imagine if you pay a dividend, you signal to the market that you have higher expected free cash flow, and it has a positive effect on firm value on the stock price. But the two cases here are cases of imperfect information, which is not the case of Miller and Modigliani. That is to say, but that's true, it exists. When Microsoft paid dividend for the first time, some people said, oh, they are expecting to earn so much money that, they just pay out dividends. So it's a good signal. And some others said, oh, but now Microsoft is a mature company. Okay, it used to be a high-tech company with plenty of projects, but now we believe that they may be not that of an innovative company, and it's going to be bad news. So, see, it can lead to mixed signal. So, what is the end of the story for Miller and Modigliani? Of course, the end of the story is easy, and I can summarize like that. If paying a dividend, then you replace by some money. And if you are in perfect capital market, that there is no information asymmetry, the firm value will not change. The amount of leverage and the value of the leverage will not change. So the value of the equity won't change. E is equal to V minus D. If you maintain the level of debt, if the firm value is unaffected by the fact that you distribute dividend and take back some money on the market, you just have some circulation on the money on the market, then you don't create value. Okay, and so this would say that fundamentally, but the idea, is quite easy. Huh? The idea is that the money that you give away is lost at the level of the firm and has to be replaced. And there is no way that this will create value. If you want to create value, find new investment opportunities, innovate, do an acquisition with synergies, but dividend is not creating value. I think that's an important message. And that's an important message because you have many people observing higher dividend and believing that higher dividend create value. No, it's wrong. And I'm really sorry that in 20 years, people have becoming worse in understanding dividend policy than they used to be. So that's why I insist with you, and I hope you convey the right message back in Vietnam. So, of course, but okay. So if I summarize a little bit what with my small example, so what Modigliani will say is, okay, so you have a stock price of 340. Okay, so imagine, so I may have a choice, right? So I'm gonna open because it's gonna be better to have bigger. So okay, so stock price is 340 and dividend is 0, and okay, or you can choose to have a stock price of 335, and a dividend of 5. Okay, so basically, if you pay 5 dividend, okay, if you change your dividend policy, then the stock price will decline ex dividend exactly from the level of the dividend being paid out. But, and we understand that what paid out is lost at the level of the equity and the stock price. And this is Miller and Modigliani reason. But someone may say, don't we forget the risk here? And don't we forget the risk here? Saying what? Saying finally, if I look at this, this is in my pocket. This is cash. And sometimes you have this kind of argument. People saying, but when I have the dividend is my pocket. So when the dividend is in my pocket, the value of the dividend is higher than what's in the stock. And what they have in mind is risk. And it's true. If you have all the money in the stock, this is a portfolio which is more risky than this portfolio. Okay, so the volatility here is higher than the volatility here. The volatility of the overall portfolio because you have some cash. So it's true that if I have a dividend paying stock, when I receive the dividend is in my pocket and the stock price decline, then I have less risk. But what do you have less? You have less return. If you think about the future value of this would be this, and the future value here would be that. Okay, so if you look at your expected return, the expected return will be lower. The expected return that you will have 1 year from now, if I have a non-dividend paying stock, I will get KE. And if I have my dividend paying stock here, then and I keep some cash, then my expected return will be lower. Okay, so here my expected return is higher than the expected return on my portfolio here. So again, see, Modigliani Miller about leverage were saying, oh, leverage is interesting because you increase return. And they were saying, yes, but you have higher risk. And dividend, people tend to say, oh, but when a stock pays dividend, there is lower risk because I have some cash in my pocket. Yes, but you will have less expected return. Remember that if you accept to invest a lot of money in the stock in comparison to the dividend, it's because you have a higher return. Okay, so we are back to, again, risk return all the time. Okay, just not forget that each time we discuss return, we have to discuss risk or the contrary. So don't Modigliani Miller forget the risk. No, and it's called the bird Indian fallacy. The idea that if you have the bird in your hand, it's worth more than if it's in the bush anyway. So holding real investment constant, dividend payment do not make the firm less risky. Holding the same capital structure, the risk of the shares do not change when the dividend is paid out. Okay, what changes is just the wealth. The way the wealth of the stockholder is split between the stock of the firm and the risk-free asset. Okay, and that's what we just said. If shareholders do not receive a dividend, they have a higher risk, but they also have a higher expected return that rewards for the risk. Okay, so it's not that I have a dividend, so the stock is less risky. No, it's less risky maybe when you have the dividend in your pocket, but you will have not the same return. And just to make sure that you well understand that, you can create any dividend you want on a stock. imagine that you have a portfolio of stock that do not pay dividend and you want 10% yield, you just sell 10% of your portfolio every year. So the idea is that any investor can manufacture exactly the level of dividend it wants. Okay, and if we go back to things that we have been saying in the first course, is it that a company can really say that it pays a dividend so that it optimizes for all the investors? No, not possible. An investor, given his risk aversion, can decide to invest more or less cash in a portfolio, and you don't wait for the dividend. Okay, of course, dividend may be important for some pension funds, etc., or people that retire and they need some dividend, but they can create that. They just need to sell their shares, and very often it's more behavioral, it's more poor reasoning than anything else. Okay, so that's it for the Miller and Modigliani, and for what I wanted to say on capital structure and value. So I spent a lot of time on that. I'm sure that you've been learning that, but I'm sure also that you have been learning that a little bit like theory, and I hope that, rethinking about all that will be a little bit more profound reasoning for you on that. And I think it's really important. And the exercise, the case study, the Modigliani case study, the 3 exercises I give, the pharma case study, and the assignment are really meant at showing you that you can really enhance your way of reasoning if you master that. As I said, you have 3 building blocks. Capital asset pricing model. Of course, you have financial analysis, be able to compute free cash flow, whatever. But then capital asset pricing model, Modigliani Miller, and option theory is everything that you have behind valuation. Like, to assess the impact of any kind of acquisition, investment, sale of asset, sell and lease back, whatever. Any kind of operation affecting the asset side, the liability side, will be and can be analyzed correctly using those tools. But it requires some training, and it requires to rethink and work out some case study to think well about all that. So it's 3:30 or close to 3:30. It has been longer than what I expected, but that's life. That's like that. What I suggest is we will start. We will finish Monday capital structure and option theory, but we will start. But we take 15 minutes. Okay, so we take 15 minutes or maybe 15 minutes or 20 minutes. So take a break, come back fresh, try to come back fresh on a Friday evening. That life is in your cities is always very explosive on Friday evening. But I save the weekend. You work on the evening, but the weekend is safe. I don't know whether it's better or worse, but at least you can. But you can work, you can study and exercise over the weekend. So you can try to improve yourself. Boom. Nice to have you online. Okay, some others you can upload a little. You can open the camera also. Not always the same one. Okay, so we take 15 minutes and I have to make a call. See you. Okay. So let's go ahead with new things. Huh? So just the wait, wait. Okay, so let's go. I just needed to open something and get. Okay, so now is something new, and I'm sure that this you've not. I'm not sure you have ever done that, and you'll see it's really interesting, and it can be extremely useful. So what I'm gonna do is open a couple of slides to avoid losing the presentation. Okay, so the idea of using option pricing to capital structure, I think I can. There are two reasons to do that, and there is two very interesting things that for this course. The first thing is for valuation purposes. Okay, so and let's do it extremely simple. Imagine that you discover an oil field. Okay, so you discover some new oil field and you set a company to exploit this oil field. And so you have a certain level of investment and you create some value, and okay, this would be the value of your oil field. Okay, so you invest in capex and you create some value, and this would be the market value. And in order to assess this market value, okay, you can use some DCF. Okay, you can use some valuation with free cash flow and look at the right discount rate and the period during which you will exploit, etc., to value the company. And it's also so the value of the company is going to be the sum of the free cash flow discounted at the cost of capital, but it will also be the capital engaged plus the NPV on your project. All right, so I'm going to forget about and just have this for the moment. Okay, what I'm saying here is that you may have to invest. So what I'm saying here is that this is the value of the firm today. Okay, this is the value of the firm today, and the value is different than the amount being invested. Okay, now this firm, okay, can be financed, okay, this firm, you may want to bring outside investors in this company. And for that, you need to value the value of the debt and the value of equity. And imagine that, for instance, on this company, so imagine that this company is worth $200 million. Okay, so it's maybe more than one oil field, I don't know. And D0, and the value of D0, so you want to finance, and you want to finance with the debt, and the debt is paying out $125 million in 5 periods from now. And this is a zero coupon bond. Okay, and it's also financed with equity. Okay, of course, then you have the equity, and so it means that, you know, you have a certain level of capex. I don't know how much it is, and so of course you will be using the value of the debt that you can sell. Okay, this is what's promised on the debt, and you want to value the value of the debt to know how much you can invest in the capex, and then have additional equity to finance that. Okay, and the equity is paying no dividend, so the bond is not paying any coupon before the maturity, and the equity is not paying any dividend. So basically, okay, this oil is like, so you invest, you exploit the oil, and all the cash all the free cash flow that you have, you keep them, okay, and then in 5 years from now, you first pay to debt holders, and then you can keep the money or pay to equity holders, and then, you know, maybe the oil will still be flowing for a couple of years. The first thing that we want to do using option is first to understand that option behind the value of equity and behind the value of leverage, you have options. That is to say, E0 is like an option on the value of the firm. And so it means that you can use option calculation to exactly compute the value of the equity. And you will see how it's extremely interesting. Second, so first thing is valuation, is to provide a price for E0 and D0. Second is to understand with option that fundamentally, okay, equity holders and debt holders are in conflicts. Equity holders and debt holders have stake on the firm that have a very different profile. And there are many sources of conflict behind what equity holders and debt holders expect from a company. What does it mean? It means that, you know, the one that have priority on the flows of the firm are the debt holders. So those people, they have the priority. But those people, they have the control. So if you have the control, you do something that is good for you. But you do something that is good for you knowing that debt holders have priority on the flow of the firm. So you will do, so there may be some difference between maximizing firm value can be different than maximizing equity value. So far, we said that, you know, what's good for the firm value is good for the equity holders. We will see that it may be different. And this will be the beginning of some things that we will do in May when we will meet later on, when we will discuss financial policy. This will be very important to design financial policy. That is to say, you know, if when you have different stakeholders, shareholders, debt holders, junior debt holders, if you have many conflicts in the firm, okay, then those conflicts may lead to a lot of problems. And those conflicts, you want to avoid them. So it means that depending on the industry, depending on the firm you are in, you may have different capital structure. And this is about agency theory and how we can design an optimal capital structure given those conflicts. So we will discuss that. But option is useful to understand the existence of the conflict. So basically, the first thing that we want to do is to discuss valuation. Okay, and this is what we will do. What I need you to know about option, I think you all had an option class, but I still want to make sure you have things clear in mind. The first thing I want you to understand, is this. Okay, the first thing I want you to understand is how the profile of, I need very few things. We will be option pricing users, and Wide Eye Open is a software online that we can price option and play with that. What I need you to recall is, okay, so you have the strike, okay, you have the strike, you have the underlying asset of the option, and what I need you to recall as this is a call. Okay, so this is, here I am long of a call, meaning I buy a call. Okay, and I go quick because I guess, so this is the profit and loss, and here is you are short of a call. Okay, so first, option pricing, basic position of call are like that. And this is the premium. Okay, so I guess you all know that. So here I exercise. Okay, and here no exercise of the option. Okay, so this is what you have. Second, that you have to remember is the put. Okay, a call. So a call is you have the right to buy. So you have the right to buy. You have the right to buy an asset, and then you have a strike, and then you have a maturity. And so this is the profit and loss at maturity. Okay, so I have the right to buy the stock at price 50 in 3 months. Okay, so I can buy a stock at $50 in 3 months, and that's my option. Okay, second is the put. So put, here you have the profit loss. Okay, here you have the underlying asset, and here you have the strike, and this is a put. Okay, so the put is a right to sell. All right, so this means that I am long of a put. This is I buy a put. I buy, if I own a put, I have this. So I pay a premium, okay, and I want to be covered when things are bad. So I want to hedge. I want to be able to sell my asset at a certain price. Okay, so this would be, so it's going to be like here. I guess you all know that, but just to recall that a little bit. And okay, if I am difficult to do that here, okay, but this is a put, and then you are short. Okay, so if you sell a put, you are like that. Okay, so I need you to remember that. And what I need also that you remember is the price of a call increase with the volatility of the underlying asset. Okay, the price of a call and the price of a put increase with the volatility. And when we discuss volatility, we discuss volatility of the underlying asset. And so if I have an option on stocks and the volatility is picking up, then the price of my option will increase. Okay, so this you have to know that, and the rest, I guess, depends on your knowledge on option, but I think it's enough to discuss in corporate finance, but at least I need that. Okay, no question on that? Okay, so otherwise, just refresh a little bit on option if you need, but we don't really need much more. Okay, so now let's go back to my oil field and see how we can use option to price that. And so I turn to the slide. So consider the simple case of a firm, and the firm is valued, so this is my oil price, and the value is 200 million at T equals 0. Okay? And the value of the oil price is uncertain, so there is uncertainty on the firm value at T equal T, and T equal T, the T equal 5, for instance, okay, is the maturity date of the bond. And the firm is financed with 0 coupon bond maturing at T equal T of face value F. And F is going to be the $125 million. Okay, and the shares are not allowed to pay dividends between 0 and T. So it has been forbidden by bondholders to pay dividend. So you have a bond covenant saying that you cannot pay dividend between 0 and 5. So what are the possible profile of the shareholders and bondholders, taking into account a strict enforcement of the priority rules and limited liability of the shareholders? So we've been discussing that. Meaning that debt holders will not receive anything if you don't pay. No, equity holders will not receive anything if you don't pay debt holders. And in case you cannot pay debt holders, shareholders don't cover losses. That is to say, shareholders cannot have something negative when they exit. Okay, they cannot have to repay. There is limited liability. Limited liability means that you cannot have something in excess of what is in the firm. So what are the first in terms of equation? Well, you have two. Either the firm is not bankrupt. So firm is not bankrupt means that the value of the firm at the maturity of the debt is over F. So if the firm value is over 125, it means that you pay the debt and the equity is going to be V minus F. Or if V is below F, the value of equity will be 0. Okay, so you have been losing everything. Okay, you have been losing everything, and D is equal to V. And so what you have to understand here is, you have a company like that, and the company is financed at the beginning by this and leverage, and things are turning bad. Okay, things are turning bad. What does it mean? It means that, and you owe 125, and things are turning bad. What does it mean? V is small, and V is small, so small that the value is below 125. What's promised to debt holders. So what will happen here is equity disappear, and in fact, the equity holders, debt holders, become the equity holders of the company. Okay, so bankruptcy law are such that when you enforce priority rules, it means that in case of bankruptcy, debt holders become equity holders inside the company. Okay, that's exactly the view, the standard view of what should be bankruptcy if you apply, if you enforce priority rules. It's not always the case. It's not always the case. I don't know how it is in Vietnam. I could discuss with my PhD. I'm in Vietnam finishing a PhD now. I have to work with her. But like in Great Britain, it's the way it is. In the UK, it's the way it is. In Germany, it's like that. In Japan, it's like that. Not very much in the US, not very much in France. But so it means that, it's a certain way of being. But that's the idea, that's the classical idea that we have, that, debt holders have priority on equity holders. But when times are bad, if there is limited liability, equity holders, they've been losing everything, but they leave the firm. And they leave the firm to the debt holders. Okay, so this is what we have behind this. So if V is below F equals 0 and D equal V. So what does it mean? It means that, as you can observe, who is at T equal T, who is in charge of the firm? If times are good, the shareholders will have the control of the firm. And if times are bad, the debt holders will have the control of the firm. Okay, so depending on whether times are good or times are bad, the control will be in the hand of shareholders or stockholders. We are talking of contingent control. So, the meaning that the control of the firm at the maturity of the debt depends on this, depends on whether the firm value is over or not the face value of the debt. Next, it's not option, not yet. What it is just that I just say, here is the equity, and here is the equity and the value of the firm and leverage. So I just have those equations in a graph. And if V is below F, you have 0. If V is over F, you have V minus F. Okay, and here you have F, and you have V. So this is just the equation. And so, it's just turning. I'm just turning from those equations this into graphs. And of course, if you look at that, what do you observe? What clearly we can observe? Well, what we can observe is that it looks like a call. It looks like a call, except that the call will be here. Because in the design of the call that you have here, you have the premium. But what is the premium? The premium is what you pay. Okay, but here what we look at is only what you receive. You receive zero at maturity, and you have V minus F. So what would be the premium here? This is the equity. This is what you receive in 5 years from now on your equity. So what is the premium? What is the premium? What do you suggest? What's the premium, do you think? The premium is E0. That's E0. That's what you pay to have access to E at t equal 5. So in fact, what you have here is if what you get is like a call, it means that what you pay at t equals 0 is the price of a call. What is the premium? The premium of an option is the price of the call. So it means that when I am a shareholder, it is like I have a call on what? V. What is the strike? F. What's the maturity? T. So what we have here is that when I am a shareholder and I invest in a company where the debt can be risky, I have like an option on the firm value with a strike of F, maturity T. What does it mean? What does it mean? Let's think it's written a little bit after, but I want to discuss what does it mean. You're going to erase that. Okay. Imagine your flow. Okay. It's the beginning. Okay. So you have been investing here, and you have your debt that comes here. Okay. And you have your equity. Okay. So yeah, this is the expectation. And the money is okay. So the oil is flowing, and the money is flowing, and you keep the money inside the company. And at T equal T in 5 years, who are the ones that you will pay first? Debt holders. So who will receive priority on the money that is being earned and the future cash flows. Debt holders. But then, what do equity holders have? So, what I'm saying is, who is the company? Who are the owners of the company? We tend to say equity holders are the owners. No, depends. The first owners are the debt holders. But if the company is doing well, what the equity holders will do is they will buy the company to the debt holders. Okay, so the equity holders will buy V to the debt holders at price F. And they will buy that at T equal 5. So the idea is like what the option is saying is just explaining that when you are an equity holder in a firm with risky debt, either the company is not doing well and the company is in the end of debt holders, but if the company is doing well, if the company is doing badly, you let the company with the debt holders, but if the company is doing well, then you reimburse your debt and you buy the company to the debt holders. So what it does take into account this option is the fact that, if it's bad, it's the debt holders. If it's good, it's the equity holders. The equity holders have the ability to buy the company to the debt holders, reimbursing the debt if times are good. And this is exactly what you capture here. That is to say, your shareholders, what they do is they have this option to buy the company to the debt holders, and they will exercise this option when the value of the company is over V. And when the value of the company is below F, they leave the company with the debt holders. And that's why, what do you have? When times are good, the debt holder receive F, you reimburse, and when times are bad, you leave the company with the debt holders. This is the company here. So here the company is in the hand of the equity holders, here the company is in the hand of the debt holders. And if you sum up, E plus D, you obtain V. That is to say, if you sum up this line here, if you sum up this line and this line, you obtain V. So it's a way to split the value. Okay? And what you can see is the way you split the value is very asymmetric. Okay? It's a way to split the value which is extremely asymmetric. Asymmetric, I'm going to erase all that. What I mean by asymmetric is equity holders will benefit when times are good, whereas debt holders just receive F, whereas when times are bad, equity holders are capped at 0. They cannot have less than 0, okay? Whereas debt holders are losing more and more value. Okay, so there is some asymmetry. You see that those payoffs are asymmetric, but they are the reverse of each other. So what do we have? Well, first, what we have, and I'm turning to a pricer now. Okay. I'm turning to a pricer now that I hope is still open. So the pricer, you have it, is option price.com. Okay, and let's play with that. It's going to be very fun. So if I go to so it's difficult for me to open, I cannot have the slide at the same time. So we'll do the computation and then we'll save that. So how do we enter that? What is the underlying price? It's the price of the company today, V0. What's the exercise price? It's the value of the debt, 125. Then this is the number of days to expiration. This is the maturity date of the debt. Maturity of the debt. So maturity of the debt is going to be So in days, it's going to be 1,825 days. If I take years of 365 days. Okay, interest payment, I'm going to say 1. Let's say that now, this is the risk-free rate. So here, interest rate is the risk-free rate. Dividend yield, I'm not paying dividend. This is the volatility of the underlying asset. So what's the volatility of the underlying asset? Is, for instance, like I can take some oil stock and I look at the volatility of the stock and then I deleverage the volatility to have the operating volatility. I'm interested in the volatility on the operating asset. Okay, so let's say that volatility is 30%. And rounding is the number, we don't care. How many figures after the dot, so we don't care. And if I calculate that, 94, the sole thing I'm interested in is what I have here on the right. Okay, first line, price of the call and the put. The rest is delta, gamma, vega, are the sensitivity of the option to different parameters that enter into option valuation. Okay, so 94 and 13. So we keep those figures. So we keep those figures in mind and we go back to, and that's beautiful because that's done. That is to say, if I come back to this slide here, it's done. What I was able to say here, okay, is the value here of my equity is 94, meaning that the value of leverage is 106. I cannot erase that. So no. I'm going to open another one because okay, so to summarize, I use V0 underlying asset 200, risk-free 1%, volatility operating, annual operating volatility 30%, T equal 5, equal 125 days. Okay, and what I have here is, so what we have here is the value of equity is the call, 94. And the value of the debt, therefore, value of the debt is not complicated. So the value of the firm is 200, the value of equity is 94. So it means that the value of the debt is 106. That's beautiful. It took us 20 minutes. Okay, so now I exactly know how I can price a risky debt. So my leverage, okay, paying out 125, 0 coupon bond is worth 106. Okay, and the equity is 94. So it means that when this firm is investing, okay, it can sell claims and it will sell debt based on a valuation of 106 for 125 in 5 years from now, and the equity will be worth 94. So it means that you know the stock price, the price of the bonds, how what would be the value for the investors. Now what you can compute, and we will do it together, is the yield. So what's the yield at issue for the bond? Well, the value of the bond is the sum T equal 5. Sorry, there's no T equal 5. There's only one payment. So F divided by RD 0, 5. Meaning that the RD 0 is F over D0, 1, 5 minus 1. Okay, so if we apply this to the case here, okay, so if we apply that, I'm just going to open Okay, so I'm just going to open Excel here. So the 106 for the value of the debt. Okay, so 125 divided by 106. Okay, exponent 0.2 minus 1. It's going to be my yield. And so the yield is 3.3%, 335. Fantastic. Oh, no. Okay. Very bizarre. Okay, so the yield here, I know how much it is. 335%. And it means that the spread is 235% because the risk-free is 1%. Okay, so I exactly using option, I am perfectly able to value the value of the debt and know what I should pay as a yield to my bondholders at issuance of my leverage. Okay, and I exactly know how equity holders should pay for the equity. So what, and in fact, what I do is the value is like that. And in fact, the capital structure is sharing the value. It's sharing the value between equity holders and debt holders when times are good, when times are bad. And when times are bad, the company is in the hand of debt holders. When times are good, the company is in the hand of equity holders. And equity holders have an option to buy the company, the debt holders. And we will now say what debt holders are. So if we look at the leverage here, what does it look like? If you look at that, it looks like this one. It looks like a put. It look like if I sell a put. So we have to do a little bit of gymnastics here. It looks like we sell a put, except that remember that we don't have the premium here. So if we don't have the premium here, this is the risky debt. Okay, and what I'm doing here is some construction game. What I do here is, it looks like selling a put. But selling a put, in fact, without the premium is here, because we don't take into account the premium. We will go back to the premium. So it's here. So what we do, in fact, is a risky debt is a structured product. And a structured product where you have the red line, and the red line, which is paying F, whatever the value of the company, would be a risk-free debt. Or it would be a debt that has a guarantee, or a debt in an unlimited liability company. So if there is the oil price and it's 125 million, but then you have a guarantee on a real estate outside the oil price that's worth far more than 125, then you have no risk on the debt. So the blue line is the red and the green line. Okay, and in fact, what you have here is that in order to value the leverage, okay, so the value of leverage, we know how much it is. The way we computed the value of leverage is because we said the equity is like a call. Okay, and if it's 94, option pricing said that, it means that the debt is 106. How can I find 106? The way I can find 106 also is to say that it's like a risk-free debt. Okay, so it's like a risk-free debt. So a risk-free debt will be like that over 5 years, minus I sell a put. So if you sell a put, it means that you sell to someone the right to sell you the company. So remember that selling a put means that you have the obligation to buy. To sell a put to someone means that you have the obligation to buy. But if you have the obligation to buy, you receive a premium for that. So it means that this will be reduced of the value of the put. So the value of the debt 106 is also the, so you can check that to be completely is going to be approximately that, and I will tell you to be not approximately, but it's just a problem of discounting. Okay, if you do that, 0.1.5 minus the put, and the value of the put was 12. Cannot remember. Was it 12 or? I'm going to check. Okay, so the value of the put here. The value of the put is 13. Okay. So anyway, it's going to be approximate because I don't have the rounding, so it's not very precise. But if you compute that, 125 discounted at 1% over 5 years, so this is the risk-free rate, minus 13, the put is going to be the value of the debt. Okay? If you want to have the perfect computation, in fact, you have to take 125 and exponential minus 0.2 multiplied by 1%. It's continuous discounting because what the option model assumes is that you have continuous compounding of the interest minus the put here. And of course, you have to keep on the rounding. Okay, so it means that when you buy a risky debt, it's like you have a risk-free debt plus you sell a put. And what does this put tell you? Think about it. This put tells you that you sell to someone the right to sell you the firm at a certain price. And who do you sell the put? Who is buying the put? You are seller of put. Who do you sell the put to? You sell the put to the shareholders. Think about that. It's not very difficult. And I'm going to summarize that if you want. But here you can see this is the call. Okay, but the call is like, okay, what I'm gonna open something like that so that you understand better. So it's better if we do that dynamic. One thing that, a way that a firm could be arranged is like that. Is if I have no limited liability on the debt, if I have no limited liability, or if I have a guarantee of a debt, well, the equity holder, so imagine that you have a debt and there is no limited liability. So meaning that the debt is always paid. Okay, if the value of the firm is below F, you exercise the guarantee. So you will, for instance, take the real estate that is in guarantee and you can sell it. So you will exercise your guarantee on an external asset outside the firm. So this is risk-free debt. And then the equity holders will be like that. Okay, so this would be equity with no limited liability. You provide a guarantee or you have no limited liability. So this would be one arrangement possible. Of course, it may be, imagine that you sell stocks to equity holders. It may be difficult for people to accept to have no unlimited liability. So what they want is they agree to lose, but they don't want to lose more. I'm going to try to take another color. Okay, so they don't want to lose more than what's inside the firm. So in fact, what they want to have is this maximum. And they would like to have this. That is the call. That is, so here is the limited liability profile of equity holders. Okay, and this is the one we started with. And you see that in order to go from the blue, in order to go from the red to the black line, what you need to do is to do that. You have to buy a put. So if you want to go from the unlimited equity to limited liability, what you have to do is buy a put. You have to buy a put on V, strike F at period T. And if you buy a put, of course, you pay something. Okay, and what you pay is the cost of the limited liability. So if you don't want your shareholders to have negative outcome at the maturity of the debt and have limited liability, you have to protect yourself with the limited liability. But this limited liability has a cost, and it's exactly like a put. Okay, you see that the red and the green gives you the black. And okay, and of course, who is selling the put? The ones selling the put are those guys. That is to say, here, you sell the put to the equity holders. Okay, you sell the put to the equity holders. And as you sell the put to the equity holders, okay, your profile, the profile that you have now is like that. Okay, and we are back from the initial situation of the equity holders with limited liability and the debt holders with limited liability of equity holders, meaning risky debt. What creates the risk on the debt is the limited liability of the shareholders. Okay, and that's it. So it means that I can value the equity as a call, I can value the leverage as a risk-free debt, plus I am short of a put, so I receive the premium of a put. And the premium that you receive on the put, what is that? Is just the cost of default. Is just the cost of default in dollars. Okay, what it costs to equity holders is what debt holders require as a premium on the leverage. So I'm not going to say cost of default, I'm going to say default premium. Okay, so this is what you require on your debt in terms of debt reduction in value, so that you accept to buy a debt. So that's exactly what you have. And you see that, in fact, what triggers the limited liability, or what the limited liability is what provides an option profile to the equity holders and the shareholders and the debt holders. Okay, so this is where we are. And so if I just summarize here, bondholders expect a reimbursement of F, but they have sold to the shareholders the ability not to pay F in exchange of the firm's economic asset. They have a put option. And the price of the put corresponds to the cost of default. And shareholders have a put on firm value that they exercise at T when the firm value is less than F. Okay, otherwise they exercise their call, that is to say they buy the firm to debt holders at price F paying, reimbursing the debt. So if we summarize so that it's quite clear, what do we say? Equity holders own minus F to debt holders. Okay, so you owe 125. Okay, you have to pay, the firm has to pay 125 to debt holders at T equal 5. And what we say is that shareholders, they have a call on V, but they also have a put on V. Okay. Two situations. First situation, V is over F. If V is over F, what do you? So what we are saying is that you have a call, okay, but you also have a put. That is to say, you have a call and you have a put. Okay, so what does it mean if V is over F? What do you exercise? You exercise the call. So what you will do is exercise the call. And what the call tell you is you buy V, meaning the firm, to debt holders at F at period T. So, in fact, you reimburse the debt. Okay? And second thing, V is below F. Then what you do is exercise the put. Okay? And what you do is sell. What you do in this case is you sell what the firm, to whom the debt holders, you exercise the put that you have on the debt holders, okay, at price F at the maturity of the debt. And this way, you are able to reimburse your debt. So either you pay the debt and you get the firm, either you give the firm to debt holders and you can reimburse your debt. This is the bankruptcy procedure. Okay, so see, that's a wonderful tool in order to price risky debt, equity. And you know, it can be used for large firm, it can be used for small firm, it can be used on project. It's really extremely useful. The input that you need are not that big to get a sense of what's the correct pricing of the leverage. So if we summarize a little bit this, so the risky debt is the risk-free debt minus the put. And this we have to discuss a little bit, but I want to discuss, I'm going to open a slide and we will have fun a little bit, enlarging a little bit our case study. And it comes to this discussion. Okay, so far, what we said is we took our oil field, value 200, volatility 30%, and we said equity value is 94 and value of debt 106 for a face value of 125 in 5 years from now. Good. Imagine now that you have a conflict. And this conflict makes the price of oil increase, okay? But at the same time, the volatility is increasing. We are in this situation now. Oil price increase and volatility increasing. Imagine that, that's the guess I make, that, you know, increase in volatility, the cost of capital is increasing, but the free cash flow of the firm is increasing. But if I compute, so volatility is increasing, is doubling. So the volatility is turning not to 30, but 60%. But I consider that the value of the firm has not changed. Free cash flow increase, cost of capital increase, in fact, you know, it compensates. So what I have here is what? So I set my company in January, and then the Ukrainian war starts, and then the oil price increase, and the volatility on the market is huge. And if I compute the value of the company, I say, well, it doesn't change much. Okay, but what has changed? Well, what has changed is the volatility is not the same. And if the volatility is not the same, who is benefiting from volatility? Those guys. Those one will benefit from volatility. Why? Because they have a call. And when you have a call, of course, the price of a call will increase with volatility. Huh? Why is it so? Can I erase this? Why is it that the volatility? Because what is risk? Risk is you go here or you go here. When you have a call and you go here, you benefit. When you go here, you are capped to zero. You cannot lose more than zero. You cannot go below zero. Whereas when times are good, you benefit. So it means that if you have, I can design this here. So this is some volatility behind the underlying asset, and the risk is increasing. The risk is increasing means the dispersion has a higher volatility. And if you have higher volatility and you have a call, well, you see that here you are capped to zero, and here you benefit from higher payoff. So it means that the value of equity will increase. So let's compute that. Okay, so if we turn to the pricer, and we turn to the pricer here and we say, okay, so still 200, still 125, still same number of days, still one interest payment, volatility, this has changed, 60. Calculate 125. So the call is 125. And the put is 44. So if I turn 125, so if I go to here, so what does it mean? It means that my equity value is 125 and my leverage is 75. Bad news for debt holders. Good news for equity holders. So what you see is the value of leverage has been declining. Why is it so? Well, it's so because your yield when you issued was 335, but now the yield is far higher because the risk is far higher. But it doesn't mean that you will change the contract. You will pay, let's compute the yield just to have fun. 75. Okay, I just do the computation here. So 125 divided by 75. So this is the new value of the debt. Exponent 0.20. 10.7, right. Okay, so when the volatility is increasing, it's not my fault, it's the war. Then it means that as equity holders have a call, the value of equity will increase. But if the value of the firm is the same, it means that the value of the leverage will decrease. And the value of leverage will decrease to 75. And if you compute the yield now, the yield is now 10.7%. So it means that the yield is increasing because the default risk has increased and it will transfer into a lower value of debt. Doesn't mean that I'm going to receive 10.7%. It means that I'm going to lose value, so that the value of the debt will be in line, okay, with the level of risk. The yield of the debt will be in line with the risk of the debt. So I'm talking of market value of debt, but it means that I'm going to lose here, I'm going to lose minus 31. And those guys, they will earn plus 31. So you see that the fact that equity holders have a profile that is extremely different from debt holders makes that those claims are sensitive to the risk that is being taken by the firm. Actually, the firm did not take any risk for the moment. The firm just go to war, or there was just a war that increased the underlying operating risk. That's what happened here. Okay, so I look at my clock, and I think that we will finish on that because it's Friday evening, and I think that it's good that you, before I go on junior debt and convertible, I think it's important that you can watch back the video and think again about that. But I just want sorry. I just want to finish on something a little bit so that you can, you can think a little bit about that. Imagine that now my company is not an oil field. My company is a plant, and the plant is doing shoes. Okay, and I'm a French company. I'm in France, and I consider a project of having a plant making shoes in Portugal. So Portugal is a country south of Europe, okay, and it's the Eurozone. So I have the same currency, and the level of risk is the same as in France, etc. So I decide to set my plant in Portugal. And this plant is financed with leverage. And so I go and I find some leverage to banks or private debt, to funds. And my debt is worth 106 and my equity is worth 94. And there is a certain volatility of my business associated to being in Portugal, the level of production, the industry I am in, etc. And this is a project. So, I'm raising money based on doing a plant based in Portugal, making shoes, and I have some money flowing inside the company, leverage and equity. And suddenly, me, as a CEO, I'm aware of an opportunity of buying a company in China. So instead of investing in a plant in Portugal, I can go and buy a plant that already exists in China. And of course, I will sell to my domestic market, etc. in Europe. And, the idea is that if I go in China, I will have better margin, but then at the same time, maybe I have more risk, I have currency risk, I may have quality risk, I can have risk on quality, I will have supply chain disruption, I have more working cap because, I know all this very well. Because as you know, I know retail very well, so, there are many topics that I should address if I do that. Plus, also I have problem of sustainability. Shall I go far? Shall I go close? What about my customers? So all this. So I take all this into account, and I consider that obviously doing that will increase the risk of the company. And if I consider the free cash flow of the company that will increase and the risk of the company that will increase and discount factor that will increase, etc., I consider I am now the CFO of the company and I have some very good analysts that help me. And if I compute the value of the company going to China, I say, well, given what I earn in terms of margin, but given all the working cap, risk, higher cost of capital, etc., I think the firm valuation will go down. Okay, so here what I'm saying is going to China is NPV negative. So turning the project from Portugal to China is going to be a negative NPV project. So what do? We stop. If you look at textbook, they say, well, so you are comparing to investment, Portugal of China, and China is not as good as Portugal. So, but don't forget now that we already have investors coming to the company. So some people give money to the company to build a plant doing shoes. So, what's interesting, again, is to compute. And what we want to compute together is the following. And what we want to compute is the value of the stock. And the value of the stock, so what has changed now is that the value is going to be 190. Okay, so the value, so I've been losing you here, hopefully it works. Okay, so the value of the stock is 190. The exercise price is 125. Okay, the volatility now is 50. Okay, and if I calculate that, I have 106 and 35. So this is what is of interest to me, 106. So I go back here, and what option pricing tell me is that it's 106. Meaning that the value of leverage is 94. Not 94, sorry, 84. Because it has to be 190. So look what happened. If I go to China, I lose 10 on the firm value. Okay, but the value of leverage will decline by 22. The value of leverage will decline by 22. And the value of equity will increase by 12. Interesting. So what's the takeaway here? And the big problem is that in this case, you do something that destroys value, but then you destroy the value of that more. And finally, the equity value is increasing. Because what you do doing that is transferring so much risk to debt holders that equity holders benefit from doing that. So despite the fact that you lose firm value, you destroy so much value for debt holders that you increase the value for equity holders. So you see that behind that, there's a conflict, there's a big problem, because it means that having leverage and equity may provide bad incentives. Okay, it means that leverage may convey in the firm bad incentives. Okay, so I think, and I cannot see you anymore with the other computer because again I've been ejected. And I think it's time to bring to a close this session. So let me come back to you. I have so many windows that. Oh, it's not this one. you're still here. No, so my other computer broke down. Okay, so I'm not gonna, I'm gonna, well, okay. No, so you still see the screen, okay? So just to finish on that, and we can, maybe I just can show you that, okay? And we'll finish on that. Is that the firm value is the value of equity plus the value of debt, okay? But the value of equity is like a call. And here are just the parameters that have an influence on a call. So, for instance, if you also know that if you increase the maturity of the option, the value of the call increase. If you increase the volatility, the value of the call increase. So here we summarize a little bit that. Okay, the first case of the oil is that if you increase volatility, you increase the value of equity and you decrease the value of debt. Okay, and what we saw, so an increase in the operating risk, which holds the value constant, increases the value of the stock. And what even we saw is that think about the case of the company in Portugal going to China. Okay, value was 200, value was 190, but the value of equity going to China was increasing. And why was it increasing? Because the value of the debt was really decreasing. So the firm value was decreasing, but the leverage, the value of debt was so much decreasing because of the higher risk that the value of equity was increasing. And of course, this is bad because it says that leverage may provide wrong incentives to shareholders. Okay? And of course, debt holders are not stupid, so they can expect that. And we will see later on what it means. But this means that between equity holders and debt holders, this is conflict. This is complicated because equity holders and debt holders have claims on the assets of the firm that are very asymmetric. That's why we have this result. Okay? So for next time, that is Monday, because the weekend has started for everybody, and will start also for me. What I would like is, so I expect that you work a little bit on what we did so far, because, you know, at the end of the day, there will be some work on the case study. So please work Modigliani, work Pharma, look at option, look at everything we did so far. If you had no time or you were a bit distracted, which is always the case, look back at the video. Come back with question Monday. Monday, we will correct Modigliani and look also at exercise 1, 2, not 3. 3 is taxes, we have time. So look at exercise 1 and the answers. Okay, and we will be discussing Modigliani. Monday, we will discuss Modigliani and we will hopefully finish this handout looking at I can just say a word. We will be looking at junior debt and we will be looking at convertible. Okay, so we'll be looking at junior debt and we will be looking then at convertible, still using option and still saying important thing in terms of financial policy. Okay, so that's what we will be doing. Now it's 5 p.m. for me, for you 10 p.m. Time to go get a beer and say bye up to Monday. Okay, bye. Any question before we leave? No, not much. Okay, not much on the chat. Okay, thanks. Serious. Okay, good. I hope you follow. And Monday we'll go. But you know, you will have to work on that. So you know, like Modigliani, Pharma, case study, you have to work on that. And then, you know, even option, I will give some option pricing in the assignment so that you have to train yourself with that. So you will be forced to think again about all that and, you know, apply that. Huh? But it's going to be fun. You will improve. Huh? The goal for me is that you improve. Okay? See you Monday. Have a nice weekend. Relax. Huh? Okay, I'm gonna see the nice weather outside. My voice, I'm losing my voice now. Okay, bye-bye.